Picture this. You open your banking app one morning and it just won't load. Spinning wheel, error message, nothing. And for a split second, before your logical brain kicks in and says, oh, it's probably just a server issue, there's this tiny primal jolt of panic, that flicker of, wait, is my money actually okay? Most of us have felt some version of that, even if it lasted only a few seconds before the app finally loaded and your balance popped back up right where you left it. Honestly, I used to think that feeling, that gut-level fear about a bank, was kind of a relic, something from old black and white movies. People in long coats crowding around a locked bank door. I figured modern banking had basically engineered that fear out of existence. And then I started reading about a financial crisis that most people have never even heard of. And it completely rearranged how I think about banks, trust, and why the entire system we rely on today even exists in the first place. Because here's the thing. The reason your banking app loading a little slow doesn't send you into a genuine panic today, the reason there's a lender of last resort standing behind the whole system, traces directly back to 3 wild, chaotic weeks in the fall of 1907. A crash you probably never learned about in school. One that nearly took down the entire American economy and, weirdly, was stopped by one guy, in his personal library, more or less, refusing to let a room full of bankers leave until they fixed it. So let's get into it, because this story is honestly one of the wildest, most underrated chapters in financial history. The Spark, a copper scheme that blew up spectacularly. It starts, of all places, with copper. In October of 1907, a businessman named F. Augustus Heinze and his brother Otto, along with a speculator named Charles Morse, tried to pull off what's called a corner, basically, secretly buying up so much stock in a company, United Copper, that they could control the price and squeeze anyone betting against them. It's a classic, greedy Wall Street move, and it backfired almost immediately. The stock price collapsed instead of soaring, and the scheme fell apart within days. Here's the breakdown of why this mattered beyond just one bad trade. Heinze wasn't just some random guy. He was the president of a bank, and once word got out that he'd been involved in this failed scheme, people didn't just lose confidence in him. They lost confidence in anything connected to him. That's the part that should sound familiar to anyone who's watched a scandal spread today. It's never really contained to just the person at the center. It's contagious. And in 1907, with no social media, this contagion spread through whispered conversations, telegraph wires, and newspaper headlines. Slower than today, but honestly, not that much less devastating. The domino falls, a run on Knickerbocker Trust. This is where things get genuinely dramatic. There was a large, respected financial institution in New York called the Knickerbocker Trust Company, and its president had ties to the same speculator involved in the copper scheme. That connection alone, just the association, was enough. Depositors got spooked and started lining up outside the Knickerbocker's doors, demanding their money back, all at once. Now here's the simple concept underneath all of this, because it's honestly one of the most important ideas in all of finance. Banks don't keep all your money sitting in a vault. They lend most of it out, invest it, keep it moving. That's literally how banking works, and how it makes money. Which means if everyone shows up on the same day demanding cash, there simply isn't enough physical money to hand out, even if the bank is perfectly healthy on paper. Knickerbocker paid out something like $8 million in just a few hours before it had to shut its doors. Not because it was necessarily broken, but because the fear itself became the problem. Why does this matter to you, sitting here in the present day? Because this is precisely the mechanism deposit insurance was eventually built to prevent. Understanding this old, ugly domino effect is honestly the fastest way to understand why something like the FDIC exists at all. It's not bureaucratic red tape. It's a direct answer to this exact nightmare. One man, one library, and a genuinely wild rescue hare. Here's my favorite part of the whole story. And I still think about it kind of often, honestly. There was no central bank in America at this point. No Federal Reserve. Nobody officially in charge of stepping in during a crisis like this. So the man who essentially did the job was J.P. Morgan, the most powerful private banker in the country. operating out of his own personal library in New York. Morgan gathered the heads of the major banks and trust companies into his library over a series of tense nights, had his people go through their books to figure out who was actually salvageable and who wasn't, and then, according to the stories, more or less locked the doors and refused to let anyone leave until they agreed to pool their own money together to backstop the weaker institutions. Picture that for a second. A handful of the most powerful men in American finance, essentially trapped in a rich guy's home library at midnight, being pressured into saving the system because there was no government mechanism built to do it for them. It worked, more or less. The panic slowed. The stock exchange, which had come dangerously close to shutting down entirely because brokers couldn't get short-term loans, stayed open. But, and this is the part that should genuinely bother you a little, the entire American financial system had just been saved by the personal willpower and private fortune of one guy. That's not a stable system. That's a lucky one. The uncomfortable truth, the system itself was the flaw. This is where the story stops being just a wild anecdote and becomes something you actually need to understand. The reason 1907 spiraled the way it did wasn't really about copper, or Heinz, or even Knickerbocker specifically. Those were just the sparks. The real problem was structural. The United States, at that point, had no central authority capable of stepping in during a crisis, injecting liquidity, and calming markets down. It had been without a central bank for decades, ever since an earlier version was killed off in the 1830s. So every previous panic, and there had been several before 1907, kept exposing the same fundamental weakness. There was no safety net, no lender of last resort, just a patchwork of private banks, trust companies with weaker regulations than actual banks, and, when things got bad enough, whichever wealthy individual happened to be willing to step up. Relying on that, again and again, is honestly a bit like a city with no fire department, just hoping a rich neighbor with a garden hose shows up whenever a fire breaks out. It might work a few times. It's not a plan. And this matters because it reframes something people get wrong constantly. Panics like this weren't really failures of individual greed alone. They were failures of design. The people involved were often reckless, sure, but the system practically guaranteed that recklessness would eventually spiral into disaster. From chaos to policy, how 1907 built the Fed. So what actually came out of all this? Congress, rattled by how close the country had come to genuine collapse, and honestly a little embarrassed that a private banker had to play central bank, passed legislation creating a commission to study the problem properly. That commission spent years examining banking systems, both in the U.S. and abroad, trying to figure out how to build something more durable than hope a billionaire is paying attention. Eventually, that work led to a series of secret meetings among top bankers and lawmakers. Genuinely secretive, often a private club, working under fake names to avoid tipping off the press, to draft what would become the blueprint for a real central banking system. And in December of 1913, a little over 6 years after the panic, President Woodrow Wilson signed the Federal Reserve Act into law, creating the Federal Reserve System. Here's why that detail should land for you personally. The entire reason the Fed exists, the entire reason there's an institution whose job is to step in during banking crises, adjust interest rates, act as the lender of last resort, is because the alternative was proven, in blunt, terrifying fashion, to not work. It wasn't theoretical. It was tested. It nearly failed catastrophically, and the Fed was the direct answer. Why a crash from over a century ago still explains your bank account today. So why should any of this matter to you, scrolling through your phone in the present day? Because basically every layer of stability you take for granted in modern banking, deposit insurance, a central bank that can inject emergency liquidity, regulators watching trust companies and banks alike, exists as a direct response to exactly this kind of failure. When your banking app freezes for 10 seconds and you don't spiral into genuine panic, that calm is inherited. It was paid for by people who lived through moments when that calm didn't exist at all. I think there's something oddly grounding about knowing this. It's easy to feel like the financial system is just this permanent, unquestionable backdrop to your life. Like gravity, it's not. It was built, piece by piece, often in response to genuine disaster, by people trying to make sure the next generation wouldn't have to watch a single banker's personal fortune stand between the country and collapse. Bringing it home. So look, the Panic of 1907 isn't just a dusty historical footnote. It's the origin story of the very system quietly protecting your paycheck, your savings account, your peace of mind, every single day without you noticing. A failed copper scheme turned into a full-blown run on the banks, which turned into one man's library becoming the unofficial headquarters of the American economy, which turned into the sober realization that the whole country needed something sturdier than luck and goodwill. The next time your bank sends you some routine notification, or the market has a rough week and the headlines get a little dramatic, I want you to remember this story. Remember that the calm you feel, the basic assumption that your money is safe, isn't automatic. It's the result of lessons paid for in genuine chaos. And maybe that's worth carrying with you, not as a reason to worry, but as a quiet reminder to actually understand the system you're relying on, instead of just trusting it blindly. Because the people who lived through 1907 didn't get that understanding until it was almost too late. You get to have it now, for free.